Thank you. So we're going to have the...
One microphone, right?
Just one microphone, yeah.
So I'll be next to you.
Perfect. So, thank you very much for the invitation. So, I'm here today from AmaZix, and before telling about what AmaZix is, I will assure you, I'm not here today to sell you anything. What we are here today is to give you a brief overview of what is going on in this space. And together with me, I have my colleague, Macedo. He is head of advisory in AmaZix, and my background is the following. I have a PhD in international tax planning. I have worked many years in Deloitte, but today I'm a venture capitalist myself. And I chose to invest directly in AmaZix because I saw that they were doing something that was extremely interesting in this space. So what they have done so far is that they have raised more than $1.3 billion by advising more than 120 projects so far. So they were doing something, and that was why I chose myself to invest in them and then work with them in order to bring AmaZix to the next step. So basically, today we'll talk about who we are. We'll give you this industry overview, and then we will also talk about how we see this market going forward and how we will suggest to make a strategy on investing. So today we have a big overview, 4 divisions in AmaZix. We have our PR and marketing team that can, on global level, assist projects in reaching out and make a fully compliant strategy on how to fundraise. Because for many projects, it's all about fundraising. Now, saying that we are not raising or asking for anything today, fact is that we are approached by many projects every week. And in fact, only 3% of these projects make it in order for us to go in and assist these projects. And the reason is that we have seen so many projects out there. We have seen what is working, what is definitely not working, and then we scrutinize all these projects, we do our own due diligence, and then we choose which projects do we want to work with. And based on all of that, we have our global team, and we have these different areas. So we can assist with consulting, that is our advisory team. We can assist with tax and legal, the global structuring, and then finally, the fundraising space. And fundraising for us is an art. You simply have to identify who are we aiming? What is this project about? And what is the underlying value of what we are bringing to market? And that is what we use our team to, and then ultimately, and this is a big secret, but ultimately right now we are working on setting up our own venture capital arm, so people will be able to invest together with us based on the projects we have identified in the market. And if we see how we do it, I mean, it's all about due diligence, going deep into every project. It's all about planning to look into the strategy, what are we doing, and then execute it. But it's not only about executing, because everyone can execute something, but it's also about looking into the market afterwards. So there is pre-investing and post-investing. And for us, it is extremely important that when we work with a project, then the work done before raising capital is as much afterwards, when we then secure that these projects will not just drop down. So we prove this strategy to the market. That is what we have done so far. And by saying that, I will now give the word to my colleague, because now we go into the next phase. What is the market right now?
Thanks Jeppe for the introduction. Yep, so as you said, we're AmaZix, we're 4 departments, about 60 people overall. I'm the head of the advisory department, so we have a team of about 10 analysts, economists, finance people, both from hedge funds and private equity, computer scientists, and our job is to sort of analyze these projects, to do the due diligence, and also to prepare all the technical sides, so token economics, market research, business plans, etc. So we have a really good overview on the industry, from working with Bancorp to start with, the first ICO raised 150 million with them, and then all the way now to STOs, where we're working with big institutionals like the biggest bank in investment bank in Latin American stuff. So we wanted to give you an overview of how we see the industry, what we see the trends are, where we've come from, where we are now, and where we're going. Okay, so where we've come from. So as most of you here will have known, Bitcoin launched in January 2009. You know, at this point it was mainly used by crypto punks and people of that nature. It wasn't really thought about. Then in 2011, Bitcoin for the first time gained parity with the US dollar, right? Silk Road launched, so we actually had a use case for Bitcoin, buying drugs on the internet. And then obviously in 2013, we had the first big mainstream bubble. It hit $1,000. And here the comparisons to tulips started, right? This is a bubble, there's no intrinsic value, it's just like tulips, etc. So then Bitcoin had its first major crash as well. Everyone thought Bitcoin was dead. At this point, the blockchain not Bitcoin narrative started, right? This technology is really cool, but actually we don't need the asset, we just need the technology itself. In 2017, after 2 years of playing around with these private blockchains and very little fruit coming of it, people started to realize that, you know, the intranet approach, which is what a private blockchain is, doesn't work. The cool thing about these networks is that they're open and permissionless, and the crypto asset is essential to sort of regulate the incentives between the different stakeholders in that community. So then finally, obviously, people started looking for a different blockchain because the narrative became, well, Bitcoin was the first, it can't be the last. You know, when has that ever happened in a market? So Ethereum launched and all these ICOs trying to differentiate from Bitcoin. And finally, in 2019, what we've seen is that most of these ICOs failed to meaningfully differentiate, and we now have a scenario where we're building vertically rather than trying to expand laterally and build more protocols. So what we've seen over the history of Bitcoin is that it's anti-fragile. You know, if you're feeling depressed in the next bear market, I recommend you go to the Bitcoin obituary site and see all the different times that Bitcoin has been called dead. It's over 360 times. Okay. And of course, Taleb has this great term, anti-fragile, which is what's the opposite of fragile? You know, fragile is something that gets harmed by disorder or chaos, and the opposite generally people think is robust, but robust is something that isn't affected by chaos. Now, something that's anti-fragile actually benefits from chaos, and that's what we see with Bitcoin, right? It's been called dead 360 times, it's gone through more crashes than I can name, and yet it's still going strong. So where we are today, if you follow the Carlota Perez model, what you see is that every single technological revolution over the last 200 years, from the Industrial Revolution to the Information Technology Revolution we're going through now, followed the same sort of pattern, right? It starts off with an installation phase, and this installation phase always ends with a frenzy and a bubble. And this happened with radio, it happened with railroads, it happened with canals, it happened with all of this. And then after the bubble, there's a crash and a recomposition where the synergy actually started. Obviously, we all know this happened with the internet in 2000, but it also happened with canals, and people were building loads and loads of canals thinking they'd be useful, and the same thing with radio. So what we believe is that we're still actually before the crash. You know, this crash that's just happened is not the big one, because bubbles don't happen without institutional investors. And in the last crash, it was driven only by retail. There was no institutional investor infrastructure, and now what we're seeing is there's custody solutions, there's trade execution solutions, there's all this stuff, which means that we believe the next bubble will actually be driven by institutional investment and real use cases. So this just sort of solidifies what we just said. You know, it's a graph of user growth on the internet from 1990 to 1995 versus 2013 to 2018 for the blockchain. As you see, we're sort of at the very bottom of that long exponential curve that the internet was on. And you know, just to give you some context, in 1994, Amazon had just been founded, Apple had a 4 billion market cap, and the www had just been invented 4 years before in 1990. So all this to say, we're very early, we're very far from the mainstream adoption that we're all looking for, because we're still building at that base layer, the protocol layer and the infrastructure layer. Now, where we're headed, I sort of like to divide where the market's headed into 3 synergistic narratives. So the first one is hard money. It's probably the easiest to understand. It's the one espoused by most Austrian economists and people like that. It's the idea that Bitcoin is a global, censorship-resistant digital store of value that's uncorrelated to other assets. Okay, digital gold, let's say. Then we have open finance, which is the idea of programmable money, or rebuilding our financial system in a decentralized way. And then we have Web 3, which is re-architecting the web to make it so that you are not the product, your data is not being monetized by these tech giants, but actually you own your data and you can sell it and be rewarded for the economic value you create. So the first one, and I think this is the most important one because it's the base that everything else is built on, is Bitcoin is sound money. So Bitcoin offers a non-sovereign, global, digital, supply-capped, immutable store of value. And that's a lot of adjectives, but they're all important because they all illustrate what's unique about Bitcoin. Because all those adjectives are something that really only Bitcoin, characteristics that only Bitcoin has at this stage. You can think of it as gold, digital gold, but unlike gold, it's more scarce, divisible, durable, transferable, programmable, and it's easier to prove that it's not counterfeit. Now, of course, gold has the advantage of a 5,000-year brand, which Bitcoin doesn't have yet, but we're getting there. And then this graph just shows sort of that Bitcoin is being used as a store of value. You see the transaction volumes are fairly decent, but also the average transaction is much higher than on all these other networks. And that's similar to gold, right? It's being used as a store of value. It's not being used for day-to-day payments. And that's very important because this is not the vision of Bitcoin as peer-to-peer digital cash that was in the original white paper, right? That is far away, and that is the layer 2 that's built on top of the layer 1 of store of value. Similar to the financial system before Bretton Woods, there was gold at layer 1, and then there was cash at layer 2, and we believe that that's still to come. So just to illustrate sound money, in the developed world, we're very blessed. We have a situation where we have 2% inflation a year. 500 million people in the world are not that lucky. They're dealing with 10% inflation every year or more. Many of them also 20% or more. So this sort of illustrates, and this is where Bitcoin adoption has been greatest, is in countries like Venezuela, Zimbabwe, Argentina, where there's been currency crises, right? Where they realize the value of this type of currency. Now, I believe there's a set of macro tailwinds that make this the perfect storm for Bitcoin adoption over the next 10 to 20 years. And it starts off with Bitcoin, like digital gold, is a global macro hedge. So and you can see this even by its birth. It was born in 2009 in the wake of the financial crisis, and obviously Satoshi put a note in there, Chancellor on the brink of second bailout for banks. So he was specifically creating this as an answer to the financial crisis. And like any global hedge, it benefits from irresponsibility and chaos in the traditional financial system. And I think what we're seeing now is more chaos than ever in the traditional financial system. Although things seem to be fixed, we have quantitative easing, which is actually the biggest financial experiment of all time, much, much bigger than Bitcoin. Globally coordinated financial easing, where people are quantitative easing, where people are buying, governments are setting up to print money to buy loads and loads of assets, okay? And what's happened with quantitative easing as well is that you have to realize, if you haven't read the transcripts from the 2008 crisis, I recommend you go away and do it, to see just how experimental this was. These people were scrambling to find a solution, and they tried this and it seemed to work. They went back, tried to stop doing it, the market tanked again, did it again. This was a complete off-the-cuff, quantitative easing sounds very well thought out, it sounds very clever, quantitative easing, but actually it was something that came up with after what they did, to justify what's being done now. But it's a massive experiment. And we don't know the long-term trends of this, but results of this, but we do know that right now we have 245 trillion in global debt, which is nearly 300% of global GDP. We know that asset prices are more expensive than ever. Every ratio, like the Shiller price to earnings ratio, everything shows asset prices being more expensive than ever before. And obviously, quantitative easing has led to rising inequality. I heard someone refer to quantitative easing as universal basic income for the rich, right? If you own assets, over the last 10 years, your assets have gone up in value. If you happen to own cash, you've been diluted by inflation. So we see huge inequality and we see huge populism, right? We see Trump, we see parties in Europe as a result of this inequality. And Ray Dalio, one of the greatest macro economists of all time, macro investors of all time, says that this period reminds him of the 1930s, right? The 1930s before the Second World War, after the crash of 1929, which is similar to the 2008 crash. And what happened in the 1930s? Gold, people started selling currency and hoarding gold, so much so that Roosevelt had to ban people from owning gold privately, okay? And that's what, in our opinion, we'll be seeing with Bitcoin as well. So, and then obviously we have the last thing, which is the Fed recently capitulated and decided to lower rates, right? They tried to raise them last year, it caused chaos in the markets. Trump bullied Jay Powell on Twitter, and he succumbed, even though the central bank's meant to be independent. And then we have devalued national currencies, including Venezuela, etc. And just this stat to keep in mind, the average age of a fiat currency is 31 years. Even the dollar, the almighty dollar, in its current fiat form, not backed by gold, it's only 45 years old.
That's right. Yeah. So I have a question for you. Right now we are talking about gold, digital gold, tokens, etc. But do you know how much gold ever minted in the world? What is the value of gold as per today? Anyone knows? It's 6 trillion. So we're talking about 6 trillion value of gold in dollars. If we then look into the real estate market, then we have a market worth more than 280 trillion dollars, which means that the value of real estate out there is 36 times bigger than gold. But we are still talking about gold. And that is crazy, because if we looked into what happened in the last financial crisis, everything was built about real estate, it was mortgage, but there was no control about it. What we can do with this new revolution, this fintech thing going on right now, that is to build this layer where we build in trust and we build on smart contracts, so we know exactly who is participating in this economical ecosystem. So by talking gold, we should look into the big picture, and that is what this is all about, basically.
And that's a great point, because real estate, and all these things are being used as store of values, because currency doesn't serve as a store of value due to inflation, right? So the gold market cap is not really a good target for the store of value market cap. It's actually much bigger than that. Okay, then we have open finance, the second narrative. This has to be built on top of the store of value narrative, but this is the idea that finance is the least touched sector by the information technology revolution. We basically got digital banking, the same thing but on your phone. There has been almost no innovation. And what we see with open finance is that built on these open source protocols like MakerDAO, these stable coins, these debt primitives, we'll be able to compose these financial primitives into various different tools and allow anyone the ability to create, so basically unlocking the internet of finance, or programmable money if you want to call it, right? Where anyone can innovate on top of the system and we can create a global financial system that's universally accessible. And we see that this narrative has significant traction, where people talk about this stuff has no traction, no one's using it. MakerDAO issued 300 million of loans in its first year. Okay, that's more than Lending Club in their first 5 years. 550 million of Ethereum right now locked in decentralized finance. And there's 440 million raised in security token offerings in 2018. So open finance is also at the bottom of that exponential curve. And then we have Web3. So Web3, just one more thing on open finance. One of the very interesting things about this for me is that we're building the infrastructure, the decentralized infrastructure of a financial system. But all that's being traded right now on there are crypto assets. And there are many people working on ways to import traditional assets to this decentralized financial system, whether through tokenization or through decentralized futures. If anyone cracks that, what we'll see is a decentralized infrastructure that can instantly transplant the traditional economic system onto it, and suddenly you have a censorship-resistant global economic system that's very, very difficult to regulate and stop, which is an interesting subject in itself. Then we have the Web3, which is sort of the last big thesis in blockchain. And this is the idea that the internet, you're the product nowadays, right? Your data is the product. And this is due to sort of poor architecture at the base layer of the internet, and we can re-architect it by giving you back control of your data and allowing you to then be rewarded economically for the data you're providing to the system. And this, for me, the Web3 is just a natural evolution of technology. What we see with technology over the last 100 years is that there's always an open technology that's introduced. It commoditizes the previous technology, and value has to move one layer up the stack, right? So we had the transistor. That commoditized circuits allowed people to build these big mainframe computers powered by IBM. Then we had the microprocessor. That commoditized the cost of building hardware and allowed everyone to have a computer, smartphones, all of that. And then the value moved to the software layer, dominated by Microsoft. And then we had a mixture of Linux and the internet, two open technologies. Linux commoditized operating systems, which is now what everything's built on, so it destroyed that part of Microsoft's value. And then the internet commoditized distribution, which destroyed that part of Microsoft's value, and the value had to move one layer up further to your data, basically. And what we see with blockchain decentralization is that commoditizes the data layer and allows data to move one layer up. And where it moves to, there's a lot of discussion about, but that's what we see happening. I'll let Jeppe talk about the establishment.
It's amazing, yeah. It's always me talking about that because, again, I come from the old conservative world. So I have worked as a lawyer and everything, but what we see now is just a big revolution. And AmaZix, as we said in the start, have done more than 130 projects and assisted to raise more than 1.3 billion. But that's a lot. But we have to look into the big picture, because how big is this market? If we go into World Economic Forum, they say that within a decade, we can store more than 10% of the world's GDP on blockchain. That's a lot. 10% of the world's GNP within a decade. So, and if we look into Deloitte, my former place where I worked, well, basically they say again and again that blockchain has the potential to live up to the hype. So when we look into the internet and what happened there, it was all about exchange of information. But what we see now with blockchain is exchange of assets. And there's a big difference here, because we can all see the value of internet companies going up. But that was only, sorry to say, only information. What we are transferring here are assets. What we are doing here is a fundamental layer and platform for a new financial system that can include everybody. Not only the rich people in the rich countries. We can in fact bank the unbanked people in Africa, etc. So there are so much thing going on here. And what we can create here is a new economic boost by tokenizing assets and then bring illiquid assets into the market.
Yeah, so just to summarize, we see crypto assets as a totally asymmetric investment opportunity. It's uncorrelated to any other asset class, and we truly believe that it will drive the biggest wealth transfer event of the 21st century. And that as irresponsible as it is to have a big exposure to crypto assets, I think it's equally irresponsible to have no exposure at all to them. And so obviously now our next step is we're launching a venture capital fund, because we believe with our services, with our know-how, we can add a lot of value there. And we just wanted to give you sort of an idea of how we're thinking about it, so that maybe it can inspire you to the way you choose to invest into the space. So our insight, so the first insight that we have is that sound money happens first. So we believe of those three theses that I outlined, sound money is the easiest to come to fruition, because it only requires scalability and belief. That's what money requires. And that's a much quicker thing to do than the infrastructure that needs to be built for Web3 and open finance. We then believe open finance will happen next, because it requires less scalability, and the traction we're seeing in the infrastructure layer means it's already at a more advanced stage. And then on a longer time horizon, we believe Web3 is inevitable, that it will happen last, but there's also a super interesting opportunity. Second thing is we believe fat protocols have a slim chance. So there was this thesis in the space about fat protocols. The idea is that in the internet, the protocols, TCP/IP, HTTP, they were thin, they didn't capture much value, and the applications, Amazon, Facebook, Google, captured all the value. In our belief, and what people said about blockchain was that it would be reverse, right? These protocols like Ethereum and Bitcoin, they would actually capture value, and the applications would be thin. We don't think there's enough evidence for that right now to allocate a significant amount of capital to that thesis, because we believe in history, value is always accrued to those closest to the customer, because then they can vertically integrate out of that, right? So we think actually while some protocols will capture a significant amount of value, most value will be captured at the infrastructure and application layer. Last thing is token economics is overlooked. It's not the last thing actually, but token economics is overlooked. You know, people aren't devoting enough time to how to value these things. That's my personal area of expertise, coming up with thinking about how to value these things, what they are, and building valuation frameworks that we can use. And then finally, we also think that liquid tokens are still overvalued. Most of these tokens, most of these payment tokens, despite the 85% drop, they're still overvalued, and there's much less opportunity there than even some experts in the industry believe. So yeah, we believe in having some exposure to these liquid tokens that have a chance of becoming this base layer store of value, but mostly we believe in getting exposure through the infrastructure, the picks and shovels, and the applications, and investing mostly in equity, although tokens have to be evaluated on a case-by-case basis. And then this is sort of how we see the stack. So if you think about the three narratives that we just went through, then you have a base layer, which is necessary for all of them. They might not necessarily share the same one. It's possible that some of this is built on Bitcoin, and some of this is built on Ethereum or US or Tezos or whatever. It might be that there's interoperability between them. We just don't know how that's going to turn out yet. And that's where most investment is focused. And then you have the infrastructure layer, which is the stuff that's necessary to get this protocol ready for applications to be built on it, right? In the case of Bitcoin, it's layer 2 solutions. It's good data and good research. It's derivative infrastructure like the CBOE. In the case of open finance, you need stablecoins. You need debt primitives. You need equity primitives. You need STO infrastructure. In the case of Web3, you need distributed storage, compute, data, etc. And all this is necessary in order to build that application and get that adoption that we all want. And so we believe in investing sort of on the left there and sound money at the infrastructure layer first, and then also start to look at open finance, and then last, Web3. And then this is just sort of the value that we believe AmaZix will add to these projects. So we can add, you want to talk about it?
Yeah, so basically, again, we look into what we do before investing and then after investing, right? And it's all about doing your due diligence. Find out what's up and what's down. And we have done this in AmaZix. We have this deal flow. And that is what we will use now when we start investing ourselves. And we have the experts in-house as well. So we have the possibility not only having a natural deal flow, we can also analyze on what's going on here and then cherry picking the best projects. But that's all about before investing. But then when we have invested, then we have a, I would say, pretty strong network. Because we have been in this space since the very early days. So we know the people out there and we have the possibility to reach out to them directly. But again, we have our service arm, we have our PR and marketing, we have our consulting arm, we have our tax and legal arm, and then we have our corporate finance arm in order to support our investments. So this is how we are right now thinking about approaching the market, but it's also about how you want to approach the market. So if you have any questions out there, if you are thinking about going into some strategic placements into blockchain projects or whatever, then please approach us, because we have done this before. We would be happy to assist you, answer your questions, and let's make this happen. Because what we have right now is a lot of very bright minds with great projects. Now we need to fund them. And that is what we can do now by picking the right projects and then make this happen. Thank you very much for today.